Hello, welcome back to the show. So in today's video, I'll be talking about the greatest monopolistic stock that is crashing. So in today's video, we'll be covering a few things. We'll be covering the greatest monopolistic stock falling, Google stock, some news over the past few days, as well as some questions that you guys have left me in the comment section below. So the first stock over here that's a monopoly that's crashing today is none other than FICO, Fair Isaac. So FICO over here, it's in a free fall. Since about 5 days ago, the company is down now around 20% or so. So this company now is trading at a 75 times earnings at a $42 billion market cap over here. So why exactly is FICO dropping? FICO is dropping because the FHFA director, William J. Pulte, called for the provider of credit score to be more economical and for the privatization of Fannie Mae and Freddie Mac. So shares of FICO sunk Tuesday following remarks by the Federal Housing Finance Administration Director Bill Pulte at a Mortgage Banker Association conference when asked about the agency's push to change from tri-merge credit score to bi-merge credit score in the underwriting process. I think FICO should make sure they're being as economic as possible. We're actively looking to get it done. I don't like some things I've heard in terms of cost. I had a title lobby in as well, and I said to them, look, I think you guys have got to be super smart. Americans are upset about what happened over the past 4 years. Shares of FICO closed 8% down on Tuesday and is now down around 14% today as well. So over here, a fund basically said that there's little likelihood for transition to bi-merge and would significantly affect FICO, pointing to a pushback from Mortgage Bankers Association, 5 other industry groups, and several Republican senators who wanted to codify the tri-merge report into law. If the bi-merge were implemented and all the lenders adopted it, our calculations suggest that the negative impact on FICO, Equifax, and TransUnion adjusted EPS will be roughly negative 16%, negative 10%, and negative 10% respectively. So they think FICO is now a buy at current prices, and the likelihood of this happening is very little over here. So if you're to look into the bi-merge news over here, so this is what is going to happen. So this guy over here, Pulte, he's basically responded to the move to bi-merge versus tri-merge. So a quick primer on what that means. In the fall of 2022, the Federal Housing Finance Authority unveiled the Enterprise Credit Score and the Credit Reports Initiative. This dual-phase plan aims to shift from requiring 3 credit reports for borrowers to just 2 credit reports, termed the bi-merge. Additionally, it intends to transition from current scoring models to FICO 10 and Vantage 4.0, hence the extra impact on FICO over here. So this is what the person said about the breakdown over here. Lenders were required to put all 3 scores, and now with only 2 scores, that will reduce FICO's revenue. And the Vantage score over here will also push down FICO's pricing power, because currently now they hold around 90% of the market share. But if you have an alternative coming in terms of your Vantage score over here, this will push down their pricing power and they won't be able to increase their prices so aggressively already. So for FICO over here, it is a monopoly and the prices that they charge are going up too fast. So they just announced a 40% increase in percentage terms of their FICO scores from $3.50 to around $5. Although in the nominal terms, a $1.50 increase won't be significant to your consumers, but a 40% increase in percentage terms is quite large. So imagine if the company just holds the volume stable and they increase prices by 40%, there's just a 40% increase in profits over here that they can take home as well. So when a company is as dominant as FICO with 90% market share, there will be regulation coming into the space to limit their ability. It's similar to VeriSign, another monopoly that is regulated by ICANN over here. So there's another company in VeriSign. What they do is they sell all your different .com domains. But the problem with the business is it has too much pricing power, and that's why it's regulated by ICANN. They can only increase prices for the last 4 years out of the 7th term that they signed for 7%. So in the first 3 years, they cannot increase their prices at all. And that's why VeriSign is a sort of like stagnant or declining business. And that is what FICO could become as well if it is being regulated over here. But based on what the analysts have said, this is highly unlikely. And I think this is more of a reversion to the mean for FICO over here. It's a company that is extremely overvalued. So for FICO over here, the bi-merge of the scores will cause the pricing powers to be limited unless both scores raise their prices together. But then again, the prices increase can't be aggressive as before. FICO is still an amazing business, but regulation could be a headwind for this business over here. I remain interested in FICO, but the valuation is crazy at this point. So if you were to look at FICO's valuation over here, let's say if we were to put a 50 times earnings for this business at its current trading price of around $1,700, this company will have to grow 20% and hold a 50 times multiple for it to be around fair value also. And if you were to put a 40 times earnings for it, which is also quite high as well, this company will give you around a 5% over the next 5 years. So it clearly shows that FICO is still trading at a premium despite the drop over the past 2 days. I mean, it dropped around 20% or so. But for me, I don't think I'll be adding FICO anytime soon. The price that I'll be comfortable adding at will be around $1,300 a share. And assuming a 40 times earnings and a 20% EPS growth over here, this company will give you around a 12% return. So it's around fair value at around $1,300 a share. And that is where I'll consider entering into FICO over here. So it's still overvalued for this business, although it dropped 20% already, but it doesn't mean it is cheap by any means over here. Next portion over here, I'll be talking about Google. So Google is now the street's best AI play again. 2 days ago, during the Google I/O event, the stock dropped around 2% or so. And then 1 day later, after the street started digesting everything that was being presented, the stock is up nearly 5% today. So for Google over here, this is the Google I/O event summarized in 10 minutes or so. Let's take a look at this one.
Hello everyone, good morning. Welcome to Google I/O. We want to get our best models into your hands and our products ASAP. I'm particularly excited about the rapid model progress. And today, Gemini 2.5 Pro sweeps the LM Arena leaderboard in all categories. It's getting a lot of love across the top coding platforms thanks to all of you.
Gemini 2.5 Pro is our most intelligent model ever. And now that it incorporates LearnLM, our family of models built with educational experts, 2.5 Pro is also the leading model for learning.
I got 2.5 Pro to code me a simple web app. Someone comes to you with a brilliant idea. I'm going to add in a prompt that asks 2.5 Pro to update my code based on the image. And here's what Gemini generates. Whoa. I was able to create this just based on a sketch. But what if it talked? That's where Gemini's native audio comes in.
That's a pangolin, and its scales are made of keratin, just like your fingernails.
Today, we're making 2.5 Pro even better by introducing a new mode we're calling Deep Think. Deep Think uses our latest cutting-edge research in thinking and reasoning, including parallel techniques.
We are in a new phase of the AI platform shift, where decades of research are becoming reality for people all over the world. Introducing Google Beam, a new AI-first video communications platform. Beam uses a new state-of-the-art video model to transform 2D video streams into a realistic 3D experience. Today, we are introducing this real-time speech translation directly in Google Meet.
It's nice to finally talk to you.
Es bueno hablarte finalmente. No puedo esperar a alquilar tu casa.
Our research prototype, Project Mariner. It's an agent that can interact with the web and get stuff done. We released it as an early research prototype in December, and we have made a lot of progress since. And we are starting to bring agentic capabilities to Chrome, Search, and the Gemini app.
We've upgraded voice output to be more natural with native audio. We've improved memory and added computer control.
Google Search is bringing generative AI to more people than any other product in the world. In our biggest markets like the US and India, AI overviews are driving over 10% growth in the types of queries that show them. What's particularly exciting is that this growth increases over time. We are introducing an all-new AI mode. It's a total reimagining of search. With more advanced reasoning, you can ask AI mode longer and more complex queries.
We're excited to start rolling out AI mode for everyone in the US, starting today.
So for Google over here, here are some of the highlights that they had. So they had an Asian mode whereby Gemini now plans to basically do complex tasks across apps and data. It's not just a chat, it's an AI operator. They have the VO tree, which is a text and image to full video experience. They have the Juice, which is an agentic coding over here. So it'll be artificial intelligence basically coding on another level with context, ship features, writes text. And then they have the Imagen 4 over here. They have the Gemini 2.5, which includes your Deep Think and then new models as well, which are the highest quality out there. So Google now, in terms of the LLM race, at the top. And then you have Project Astra over here, which was mentioned earlier as well. It's real-time understanding via your camera phone. Ask search about what you're seeing and then get your contextual answers immediately. And then they have the Flow, which is your editing video software over here. So generative AI in general is making a big leap right now, and Google is at the front runners of it. So for Google over here, this is my summary. So Google is creating an ecosystem, a suite with the distribution that they have. So in all the components of Google's ecosystem, you have your Gmail, Maps, YouTube, Google Home, etc. The world is building on infer, on intent, which is your agentic AI. And Google is not just trying to monetize it, it is trying to distribute it into real time across the system it already owns. So it has the largest distribution network in the entire world, and with all the data that they have currently from the Google search inquiries and all that, this could be a possible argument that it's trying to make. It is not just trying to defend Google search, it is trying to basically implement AI into all the different components that you have today, which makes up the entire Google search. You have Google Maps, Google Images, and all that stuff as well. This will create an ecosystem for Google over here. So for Google over here, this is the biggest risk that is present today. It still remains in its Google empire. So the uncertainty today could turn into a risk someday, and no one knows the day that it will come. The company is at risk of innovation, meaning to say they need to innovate first. If not, another company could out-innovate them, which is normally a risk when it comes to owning your stock. You want companies that just do nothing and continually earn money, not continually innovate over time. And that's the risk for Google today, although it remains relatively undervalued. My fair value for Google is around $190 to $200 a share. That is where I'll be considering trying to trim my position if it gets a bit too risky for me. So this is JP Morgan's take on Google over here. So JP Morgan said, we come away from the Google I.O. incrementally positive as we believe Google is leading in many areas of AI with Gemini at the top of foundational model leaderboards, AI mode bringing Gemini into search and incorporating agentic capabilities from Astra, Mariner, and Deep Research, and Gemini become widely available across numerous platforms and device types. Importantly, Google's product innovation is accelerating, the company is shipping faster than ever, and AI mode in search is rolling out to US users just 1 year after AI overviews were introduced. We believe Google's total reimagining of search is taking shape as AI mode integrates what have been somewhat disparate AI products. We also like the keynote included use cases with commercial intent as Google Marketing Live focuses on monetization. While there's long competitive road ahead, we come away more confident that Google can successfully navigate the shift to AI search. We reiterate our outweighed price, and it's around $195 a share, around a 20 times earnings for Google over here. So for Google over here, I agree with this one. The company has shown that it is in the front runners of AI through this event over here. Although it's not overwhelmingly impressive, it clearly shows that Google is shifting towards trying to profit from AI, which is not what the other companies are doing yet. So next portion over here, I'll be covering some of the news that we had over the past few days. So the first one over here is your Microsoft layoffs. So Microsoft is laying off around 6,000 people, or around 3% of its workforce over here. So the recent layoff came after their jobs were replaced by artificial intelligence. So this shows that your AI is having some sort of positive impact on the productivity as well as the efficiency of the business. If the company can use AI and basically cut costs, this will increase their profit margins over time. So I view this as an overall positive for Microsoft over here. It means that they are able to generate returns on their AI spending over here, which is overall positive as well. Next piece of news over here is your bond market. The bond yields were extremely high because the US auction, the 20-year auction, was a complete failure. No one wanted to buy all your different US debt. So as you can see over here, all the bond yields are rising by quite a fair bit, and a higher bond yield will push down your equity price because it increases the equity risk premium for your stocks, which means there's an increase in discount rates over here. Because when your bonds are offering a much more positive return over here, you need your stocks to basically perform even better over here, which will increase the discount rate for your different stocks. So overall, if the bond market starts to implode, like what we saw before Trump basically pivoted, then we could see a lot of pressure in the stock market over the next few months or so. Last portion over here, I'll be talking about some questions that you guys have left me in the comment section below. So the first one over here, it says, I'm a big fan of your channel. Thank you so much. What are your thoughts on Intuit? So Intuit over here, if you don't know what they do, they're software. So what they do is they provide software for tax filing over here, and it is extremely important when it comes to your tax filing in the US itself. It's sort of like a monopoly there already. The only competitor for Intuit over here is your IRS. By your IRS, I don't think they have the time to basically create a free model that is as good as Intuit over here. So when it comes to Intuit over here, it has a wide monopoly in its space, but the problem with the business is simply just the valuation itself. So the company has never traded at a discount. It has never traded below a 40 times earnings, and that's the problem with the business. I don't feel comfortable buying a company at 2.5% free cash flow yield, although it's growing relatively fast, and with a majority of its free cash flow coming basically under stock-based comp as well. So for Intuit over here, I view it as a quality business, but the problem is the valuation itself always scares me away over here. Same for FICO that we talked about earlier. Next question over here, it says, nice content bro, do PDD analysis, thanks. So for Pinduoduo over here, like I said a few days ago, so the company is not as high quality as compared to Baba over here. So in China itself, I think the best investment is simply just to invest in Baba, because Baba has the retail growth, which is coming from a consumer recovery over in China as well. And then they have the other portion as well, which is your AI bet over here. So they're increasing their AI cloud growth revenue by around 18% in the last quarter. And they've re-accelerated that portion of their growth, and they're basically pumping in a lot of money into that cloud segment over here. So in China, if you were to look into the numbers for the cloud adoption is still extremely low, meaning to say there's a lot of runway for growth for all the different cloud providers in China itself. And for China, although a lot of the businesses are in commodities, there's still a lot of different tech companies and different use cases for it. So for example, in China, you have your AVs. Your AVs will need to store data somewhere, and that data can only come in the form of the cloud. Same thing for all your different healthcare businesses, your banks, your tech companies in China as well. All of them will require cloud. And for Baba over here, I'm sure they're the biggest customers by themselves. They have the Taobao, they have AliExpress as well, which definitely will use your Alibaba cloud as well. So for China over here, I think the best investment is simply just to invest in Baba over here. Pinduoduo, it's a company that's cheap, but qualitatively, it doesn't meet the expectation I want for my companies. The problem with the business itself is just it doesn't have much of a competitive edge. Last portion over here, has your opinion on Google changed after today's presentation? What percentage of your portfolio is Google? So for my percentage of portfolio in Google today, currently now is sitting at around 12 to 13%. It hovers day by day. But for Google over here, I don't think my opinions have changed. I think Google is a company that is fighting for innovation. It is basically trying to out-innovate everyone so that it can stay ahead of the risk. And that is a risk that you must own when it comes to owning Google over here. And that is not a risk that I am willing to take. And that's why I'm planning to trim some of my positions in Google when it reaches around fair value or so. Currently now it's still undervalued, so there's no reason for me to trim yet. But when it goes to around fair value or overvalue, that is when I'll start to trim my position over here, because I view Google as having higher risk than other companies like Microsoft, Amazon, as well as maybe Meta as well. Meta has cyclicality risk, but as far as Meta's moat over here, I don't think anyone will be able to replace it. But for Google over here, you have your LLMs coming up, and your LLMs are improving exponentially. So unless Google can basically out-innovate everyone, I don't think it is a stock that I would like to own 13% of. Maybe around 10, 8% or so, I'll be comfortable with that. Thank you guys so much for watching, and invest safe.